Due to erratic sales of its sole product, a high-capacity battery for laptop computers, PEM Inc. has been experiencing difficulty for some time. The company's contribution format income statement for the most recent month is given below. Note the net operating loss of $4,500. The first requirement is to compute the company's contribution margin ratio and its break-even point in both units and dollars. Recall, our break-even point is where our net operating income is zero. We're told REM's fixed expenses are $180 per month, which means to achieve break-even, we need a total contribution margin of $180. On a per-unit basis, our selling price is given as $30, and we can calculate our variable expense per unit as $21. That's the $409,500 in total variable expenses divided by 19,500 units. This means our contribution margin per unit is $9. If we take our total required contribution margin of $180,000 and divide it by $9 per unit, we get a break-even point in units of 20,000 units. On a percentage basis, our sales are 100%. Our variable expenses are 70% of sales, which is $409,000 and $500,000 divided by our $585,000 in total sales, which means our contribution margin ratio then is 30%, and that's the 100% minus 70. Or alternatively, we could have calculated that by taking the $180,000 contribution margin, dividing it by our total sales of $585,000. In any event, this gives us our break-even point in terms of sales of $600,000. That's the $180,000 contribution margin divided by our contribution margin ratio. So PEM has a 30% contribution margin ratio, and its break-even point in units is 20,000 units and $600,000 in sales. That $600,000 could have also been calculated by multiplying our 20,000 units by our $30 per unit selling price. Let's move on and look at requirement number 2. We're told that the company believes that a $16,000 increase in the monthly advertising budget, which will bring our fixed expenses up to $196,000, combined with an intensified effort by the sales staff, will result in an $80,000 increase in monthly sales. So sales will increase from $585,000 to $665,000. If the president's right, what will the effect be on the company's net operating income? All right, let's go ahead and work through our contribution margin format income statement. First, we'll pick up our percentages, our contribution margin ratio and variable expense ratio from above. We'll use that then to calculate our variable expenses. Our variable expenses will be $465,500. That's the $665,000 in sales multiplied by 70%, which means our contribution margin is $199,500. If we subtract our fixed expenses of $196,000, we'll be left with a net operating income of $3,500. So this would be an improvement over our current situation. Let's take a look at case 3. In case 3, we're told to refer back to our original data, and we're also told that the sales manager is convinced that a 10% reduction in the selling price, which means our selling price will drop from $30 per unit to $27 per unit, combined with an intensified effort combined with $60,000 in additional monthly advertising, so our fixed expenses will go up to $240,000. That's the original $180,000 in fixed expenses plus an additional $60,000. Will cause unit sales to double. So unit sales will increase from 19,500 units per month to 39,000 units per month. What will the new contribution format income statement look like if these changes are adopted? We have no change in our variable expenses per unit, which we calculated above at $21, which means our contribution margin per unit will be $6. If we multiply our contribution margin per unit of $6 by our 39,000 units, we get a total contribution margin of $234,000. But once we subtract our fixed costs of $240,000, we find this plan will result in a $6,000 loss. Again, referring back to our original data, let's consider another proposal. The marketing department thinks that a fancy new package for the laptop computer battery would help sales. The new package would increase packaging cost by 75 cents per unit. So our variable cost will increase from $21 to $21.75. Assuming no other changes, how many units would have to be sold each month to earn a profit of $9,750? Our net operating income or target profit will be $9,750. Our fixed cost remain constant at $180,000, which means in order to achieve our target profit, we will need to earn a contribution margin of $189,750. Our selling price hasn't changed. It remained at $30 per unit, which means our contribution margin per unit will decrease to $8.25. If we take our total contribution margin required of $189,750 and divide it by our $8.25 per unit contribution margin, we find that to achieve our target profit of $9,750, we'll need to sell 23,000 units. A fifth proposal has also been entertained, and it says again, refer back to our original data. We're told that by automating certain operations, the company could reduce its variable cost by $3 per unit, so our variable cost would drop from $21 to $18. However, this automation would result in an increase in our fixed cost of $72,000 per month, so our fixed cost would increase to $252,000. Let's go ahead and calculate our new contribution margin ratio and our break-even point in both units and sales dollars. Again, break-even is where our net operating income is zero. So to break even, we need a total contribution margin of $252,000. Our selling price was remaining constant at $30 per unit, and once we subtract our variable cost of $18, we're left with a $12 per unit contribution margin, which means our break-even point in unit sales is 21,000. That's the total required contribution margin of 252,000 divided by our contribution margin per unit of $12. On a percentage basis, our sales will be 100% of sales. Our variable cost now will be 60% of sales. This is our $18 variable cost divided by our $30 selling price, which means our contribution margin ratio is 40%. If we take our required contribution margin of $252,000 and divide it by our 40% contribution margin ratio, we can see that at break even, we're going to require $630,000 in sales. We could have also calculated this by multiplying our 21,000 units by our $30 per unit selling price.